Good morning, good afternoon, or good evening, depending on where you are today. And welcome to Afriforesight's first commodity webinar of 2024. My name is Vinesh Chetty. I'm the Deputy Chief Economist and Head of Energy here at Afriforesight. For those of you who are with us for the first time, Afriforesight is the largest commodity research house in Africa. We forecast prices of mined and extracted commodities, as well as costs of equipment, chemicals, and the like used in those mining and extractive industries. Our webinar today will cover a range of topics. We'll try to give you a basic outlook of the prices and expected price levels and profitability for these commodities in 2024. If you have any questions, please use the built-in Q&A function found near the top center of your screen if you're on a computer. Type your question and we will get to it at the end of the webinar. If for any reason you need to leave early, a recording of this webinar will be made available later. I always like to start us off with global growth because of its large impact on how commodity prices move. And what we see on screen right now is the percentage change in global growth. So to what extent the global GDP grew, as you see in 2021, or contracted, as you see in 2020. And our forecast for 2024 is growth. We see the world economy expanding in 2024, but at a slower rate than in 2023. Now, what's slowing growth down in 2024? China's slower recovery. After the COVID constraints came off, China was expected to grow rapidly, but they haven't done as well as people had hoped. We've also got high interest rates to combat inflation. Now, in the simplest terms, when interest rates are high, people don't have as much money in their pockets. When you have to spend a lot more on your home loan or car loan, people don't have as much money to go out and buy new bicycles, TVs, or go on holiday. And from a company perspective, when interest rates are high, companies can't as easily afford to buy new equipment or build new factories and the like. So high interest rates push down on global growth in 2024. The European economy in particular remains fragile. So while Europe has found new sources of energy, they're still exposed to international shipping, particularly of their natural gas, and that makes things quite difficult. We also have regional conflicts. We've now got a war in Ukraine, we've got a war in Gaza, and we've got concerns around what's happening in the South China Seas, and all of that adds to global uncertainty and pushes down on growth in 2024. A little bit more on how we got here. Up on the left, you see manufacturing PMIs. These are a reading of the health of the manufacturing industry in different regions. And when the reading is above 50, that shows that manufacturing is expanding, whereas when the reading is below 50, it shows that manufacturing is contracting. And you'll see that there's generally been declines in manufacturing over the last 3 years. And just this morning, we got the government manufacturing PMI out of China, and it was below 50, so showing contraction. So again, manufacturing not looking great, dragging down on the global economy. For China in particular, the construction sector is a big problem. You see here in red the world property index. So there has generally been a decline, but when you look at the China-specific side of things in blue, they've been declining even faster. And Devin will get into some more detail of the China side property problems. Then when we look at supply chain pressures, I'm sure those of you who were involved in logistics during the pandemic saw the real difficulty with particularly container shipping, got very expensive, very difficult to do. On this graph, when the number is large and positive, that's a lot of pressure on the supply chain, things not moving so well. So we saw that happen in 2021, but things generally got easier over 2022 and into 2023. But over the second half of 2023, supply chain pressure started building up again. And when we have a January 2024 number, I expect that supply chain pressure will have increased because of problems we're seeing, particularly with shipping around the Middle East. And again, this just makes global growth happen a little bit slower when there's pressure on the supply chain. Also pushing down, we have consumer and business confidence. You see business confidence in the blue has generally been declining over the last 3 years. Consumer confidence has had its ups and downs, but consumer confidence has generally been declining in the last few months of 2023. Now, consumer confidence is important because when consumers aren't as confident in their ability to afford things, we see that pushes down on purchases of big ticket items like auto sales. While in 2022, there were problems with chip shortages, car companies not being able to build enough cars. That chip shortage has started to ease in 2023 and continuing into 2024. But what we've seen in 2023 is with the monthly projections, we've started to see car sales plateauing. So even though now there are more chips to build cars, we're seeing consumers not so confident, particularly on those high interest rates, some concerns about consumers buying new cars. Now, why are those interest rates so high? Inflation. You'll see up on the left here, consumer inflation. This is what you and I feel when we go to the supermarket, when we put petrol in our car and the like. And you'll see that inflation got very high over 2021 and 2022, but has started to come down in 2023 on those high interest rates. But it's worth remembering that you see here the Eurozone in purple and the US in blue. While their inflation has come down, it's still at about the 3% mark, which is above the 2% target that they have. So they're probably going to keep those interest rates high for longer. On the producer side, you see the Eurozone got hit very hard, particularly on those natural gas prices, but inflation has come down on the producer side as well. It's also worth noting that in red, China, both on the consumer and the producer side, basically doesn't have an inflation problem. Now, what does this mean going forward? Well, 2024 is the hard year, weaker global growth in 2023, but we expect global growth to pick up in 2025. We expect the supply chain issues to get worked around, and we expect that central banks will start to cut interest rates from the second half of 2024, and that's like taking the handbrake off the world economy. It helps things pick up. Also, lots of investment in the green transition, electricity grids being expanded, battery storage, and infrastructure to try and combat the effects of climate change. So things picking up as we head into 2025. Now, what does this mean for commodities? I'll start us off with the energy side of things. Oil being the big source of energy in the world. Prices in 2024 are expected to be broadly sideways. And the reason that oil price is being kept up is supply side issues. We've seen oil tankers attacked in the Middle East. We've seen companies looking to avoid the Suez Canal and the area, and that's putting a fear premium on oil. So oil prices staying up even though demand is relatively weak. Now, while South Africa isn't an oil producer, we do use oil, and it affects pricing, particularly for shipping and for mining. Now, thermal coal is South Africa's big source of electricity. And when we look at who buys thermal coal, you'll see that it's mainly Asian buyers, China and India being the two biggest ones. And when you look at where South Africa sells its thermal coal, most of our coal, again, goes to Asia, most of it to India. Now, you'll see Europe on this graph, and Europe does buy coal from South Africa, but they're generally taking less because they now have access to more LNG and they're using more renewables. So you see South Africa mainly sells to Asia, and a little bit, you see Mauritius here, a little bit does go to African countries. Now, you might hear some stories about coal being phased out, but it's worth remembering that countries like India are still building coal-fired power stations, and a coal-fired power station that comes online today should be operating into the 2060s. So there's still a long way to go for thermal coal, particularly in Asia. Also, while most thermal coal does go into power stations, in India, they do use South African thermal coal in their steel-making process. While it is thermal coal, not coking, they use it in a process called direct reduction of iron, which gives South African coal exposure to that broad industrial side of things. Similarly, over in Pakistan, a lot of South African coal goes into cement making. What does all of this mean for pricing? Well, South African export thermal coal prices have come down from the 300 plus level that we saw in 2022 to the $100 or so per ton we see today. Prices have come down. Similarly, profit levels shown on this maroon line have come down, the average EBITDA margin in South Africa. But there is still a profit to be made in coal, despite the fact that profit margins have declined over the years. But those low prices and lower profit margins do mean that there is a weak investment case for thermal coal. But what we're broadly seeing is a case of companies who have coal mines holding onto them. We've seen the big internationals being forced out of coal, often by investors saying that they don't want to be involved in a dirty asset. Glencore previously was holding out, but even they might spin off their coal mines if they get their tech buyout. And even here in South Africa, our big player like Exxaro is pivoting away from coal. And Thungela, which is still investing in coal, is looking or has already invested in an Australian mine, giving them a bit of exposure away from South Africa. So unfortunately, the weaker price environment as well as the South African infrastructure problems, largely on the side of Transnet Rail, but also port, does make the investment case for South African coal relatively weak. But if you have coal mines, there is still money to be made from that. And as I said, there's still a lot of coal-fired power being built in Asia, and South African coal is also exposed particularly to Indian steel making, and India is a country that is ramping up their steel making. And on that, I'll hand you over to Devin to take you through the ferrous side of things.
Thanks, Vinesh. So I'll briefly be discussing an overview of the iron ore, manganese ore, and the chrome market, and just discussing where we see price movement going forward. So to start off, iron ore and manganese are the main input commodities to your crude steel industry, where China is the dominant player, producing about 51% of the world's crude steel in 2023. But since 2020, China has gradually been reducing their annual crude steel production as a part of their drive to reduce emissions from the highly polluting industry. But in 2022, weakness in China's economy, mainly due to their zero COVID policy, which they set in place, slowed economic and industrial activity and further held back production. But with the easing of this policy in December of 2022, economic activity gradually improved. Through 2023, however, not quite as the market was expecting, where China's crude steel production ended sideways for the year. We can also see this initial weakness when looking at China's stainless steel production in the third quarter, following that subsequent recovery through 2023. Now, stainless steel production requires ferrochrome, which is produced from your chrome ore, where China is also a major player in the stainless steel industry, producing about 58% of the world's stainless steel in 2022. So generally, price movement is closely related to the economic and industrial activity in China in terms of demand. So looking at China's annual imports, this contraction that we saw in iron ore imports in 2022, as seen here, is closely linked to the slowdown in China's economy. But at the same time, there were a lot of concerns about China's indebted property sector, where developers failed to complete new home developments, while new home prices and property investments declined throughout the year, which pushed down the demand for steel input commodities, where we did see a decline in iron ore imports. These concerns did persist throughout 2023. And even the start of this year, where just at the beginning of the week, China's most indebted property developer, Evergrande, was forced to liquidate to pay off its debts. However, despite this, we did see a pickup in China's imports in 2023 as their economic activity improved after they eased their zero COVID policy. On the other hand, manganese ore and chrome ore imports generally remained stable throughout 2022. This is mainly because China tends to push for regular inventory restocking to ensure that they have sufficient supply, especially since these are main commodities sourced or exported from South Africa, where, as Vinesh mentioned, logistics constraints remain a concern. So taking a look at South Africa's exports, we did see a pickup in iron ore and manganese exports in 2021 as the world pushed on with its post-COVID recovery plans. But many iron ore and manganese producers, including the biggest iron ore producer in South Africa, Kumba, so that's Anglo America's Kumba, referenced the need to work closely with Transnet to try and improve the efficiency and availability of rail networks so that they can actually get their products out into the market. So with that weak demand that we saw in China in 2022, alongside these South African supply constraints, South Africa's exports of iron ore and manganese declined in 2022. However, in 2023, with the improved demand from China, exports from South Africa did pick up, especially on the manganese, especially with manganese ore, which was significantly supported by improvements to logistics infrastructure by Transnet, such as the Mamatwana Crossing Loop extension and the ongoing ramp up at Saldanha Bay. So looking at the stainless steel input commodities, we did see a pickup in chrome ore exports in 2022. So this goes back to the global energy crunch, which began in the middle of 2021 when China had their hydropower deficiency, and then again in early 2022 because of the war in Ukraine. As a result, local electricity prices shot up, which disrupted economic viability of producing ferrochrome in South Africa, where many smelters and operations were either suspended or shut down. So this increased the need to export chrome as more bulkier concentrates, where we saw a rise in chrome ore exports. Also, towards the end of 2022, stainless steel production in China ramped up in order to meet their target for the year, to avoid their quotas being cut for the next year. So this also supported this pickup in exports in 2023. Oh, sorry, pickup in 2022. In 2023, that recovery in demand from China can also be seen in this figure, with a significant pickup in both chrome and ferrochrome exports, which was further supported by easier access through Mozambique's Maputo port. Local electricity prices should continue to pressure the ferrochrome sector. However, towards the end of last year, it's November, NERSA approved the 6-year negotiated price agreement for ferrochrome smelters operated by both the Glencore Marafe joint venture and the Samancor Chrome. And this should provide the companies with some electricity tariff relief and somewhat improved domestic production. So moving on to our outlook for 2024. We are positive on demand for both crude steel and stainless steel. On the crude steel side, looking at the iron ore and manganese price forecasts on the top of the slide, we expect large-scale multinational infrastructure projects to start gaining traction, while we also expect some stimulus in China's property sector, which should boost demand for the commodities and place upward pressure on prices. For the stainless steel industry, looking at the chrome ore and ferrochrome price forecast at the bottom of the slide, we expect construction and infrastructure projects to also support demand for the industry, but we're also seeing that positivity in a recovery in automotive demand, like Vinesh mentioned. We're expecting some easing or further easing of those microchip shortages, which should allow vehicle production to pick up and support demand for these materials. So generally, we expect this demand growth and expect prices to generally rise. However, when looking at the iron ore price forecast, it doesn't quite follow this the same upward trend as the rest of the commodities. And although demand growth is expected, downward price movement for iron ore is expected. And this is mainly because we see a significant supply growth coming out of your major global producers, especially in Australia and Brazil, which should place downward pressure on prices over this year. With iron ore EBITDA margins expected to average around 55% for 2024. There's still very good money to be made, and this is incentivizing mine ramp-ups from your major global producers. So that concludes the iron ore, manganese, and chrome sections. With that, I'll hand over to Kirti to cover your base and battery materials.
So starting off with the copper section, we see that copper is mainly used as electrical wiring or as water pipes. We expect copper demand to rise on the increasing need for electrification, where it is used for electrical generation, transmission, and distribution networks. We also see the expansion of power grids and modernization of infrastructure, which should spur demand. We expect some demand growth from renewable power generation, such as wind and solar plants, as well as battery technology as the world moves towards using green energy sources. The electric vehicle transition should be a large demand driver. Fully electric cars currently use up to 5 times more copper than a conventional vehicle, and copper is also used for the EV charging infrastructure. However, there's a high incidence of copper theft globally, which may result in copper being substituted with cheaper and lighter aluminium, especially where copper is publicly accessible. So we see this as cable theft. About 40% of supply comes from South America, where production has been constrained due to frequent community protests, stricter government regulations, water scarcity, and declining ore grades. This creates the potential for increased supply growth in Africa. We expect production increases from the DRC and Zambia due to the Central African Copper Belt. A production start and capacity ramp-ups should be led by Ivanhoe and Jin Mining's Kamoa-Kakula project in the DRC, which targets 650 kilotons per annum copper production capacity from early 2025 after its phase 3 expansion is complete. Zambia production should also rise as it targets 3 million tons per annum production by 2030, up from its current capacity of about 800 kilotons per annum. So despite the supply growth, we see that it's not fast enough to keep up with rising demand. The current figure shows mine supply in blue, recycle volumes in red, and copper consumption in green. If the current mining, recycling, and consumption rates are maintained, the supply gap will continue to widen towards the end of the decade. By 2035, it is estimated that copper supply should reach 31 million tons, and demand should reach 50 million tons. The widening gap between demand and supply should incentivize some copper producers to ramp up production in efforts to meet this growing demand. So generally, we see prices should rise slowly in the near term, and this is on gradual demand recovery in China, supported by stimulus measures. However, increases should be constrained by the weak Chinese property sector due to Evergrande's liquidation and on concerns around global growth due to the still high interest rates. Prices should then increase on slow supply growth, improving demand for electricity and water infrastructure, also on renewable energy development and the gradual but staggered adoption of EVs. So moving on to the battery metals, we focus specifically on lithium and cobalt, and we see that demand is mainly from battery production for the use in electronics, energy storage systems, and electric vehicles. The sales of battery-powered electronics, such as laptops and cell phones, have remained weak in the near term due to the weak consumer demand. However, we expect recovery due to new technology rollouts and on seasonal festive demand period later on. The demand should also rise on increasing need for energy storage applications for renewable energy plants, as many governments promote green energy use. The main demand driver for battery metals is the EV transition. So the adoption of EVs has been much slower than the market originally anticipated due to elevated interest rates that discourages consumers from making EV purchases, combined with higher EV prices, as EVs are generally more expensive than combustion engine vehicles. However, we expect a gradual staggered recovery in EV sales as governments and automakers try to meet their carbon emission goals. The EU, the US, and China are some major markets driving this transition with EV sales targets. China, the largest automaker globally, aims for EVs to account for 50% of all vehicle sales by 2035. Some governments also offer subsidies and tax incentives, but EV sales should increase at a slower than expected rate as the EU plans to allow the sale of internal combustion engines beyond 2035 if they run on carbon neutral e-fuels. So we expect EV demand to face further headwinds as the US tightens local content requirements for EVs eligible for subsidies, and as Germany ended their subsidies 1 year earlier than expected. So specifically focusing on lithium demand, we expect some downwards pressure on increasing substitution from sodium-ion batteries, especially in these low driving range vehicles, which are mainly made by Chinese automakers. So this is a relatively new technology, and we expect to see some further developments, which may result in increased use globally. But we still expect lithium-ion batteries to remain dominant in the market due to these higher driving ranges that are preferred by consumers. So the three most common types of lithium-ion EV batteries have different cathode chemistries. Cobalt is only used as cathode material in the NMC and NCA batteries to increase the driving range thermal stability. We expect cobalt demand to also face some downward pressure as some battery makers aim to replace cobalt with more ethically and environmentally friendly alternatives. The LFP batteries, shown in red, are more affordable due to the lack of nickel and cobalt and are gaining popularity. Some major vehicle producers, such as Tesla, Toyota, and Ford, started using LFP batteries in some EV models to reduce costs. We expect the market share of LFP chemistries to increase over 2024, putting downwards pressure on cobalt demand. Despite this competition, cobalt-containing batteries, shown in blue and yellow, should remain the dominant market share in 2024 as it is preferred by consumers because of these higher driving ranges. So lithium and cobalt are currently in an oversupply, and we expect them to remain in a supply surplus for 2024. Lithium supply should grow mainly in Australia and South America, but Africa has good supply growth potential. Africa accounted for about 1% of global supply in 2022, with Zimbabwe being the only producer. But African output is estimated at 4% of global supply in 2023, with active lithium mines in Zimbabwe and Namibia, and mines in development in the DRC, Mali, and Ghana. Cobalt supply should also grow mainly from copper byproduct production in the DRC and Zambia, which should be incentivized by the rising copper prices. However, due to the oversupply and the low prices of lithium and cobalt, we could expect some producers to reduce production or delay project expansions. An example of this is Albemarle, the largest producer of lithium globally, which plans to cut jobs and defer spending on a US refining project in effort to reduce their costs amid the falling lithium prices. So lithium and cobalt prices should decline on weaker than expected consumer and battery manufacturing demand due to the elevated interest rates in most regions. Prices should be weighed down further by increasing supply growth. However, these prices should face some upward pressure from gradual but staggered EV demand growth as governments and automakers incentivize EV sales to meet their emissions targets. Demand for battery storage from renewable energy plants should also put some upward pressure on prices. So now we'll be focusing on the PGM section, namely the three main PGMs, platinum, palladium, and rhodium. The main demand driver for the PGM market is the automotive sector, where PGMs are used in catalytic converters in internal combustion engine vehicles, which reduces pollutants in exhaust gases. A PGM demand should be slow over 2024. Automotive sales have been weaker than expected due to the elevated interest rates. We expect vehicle sales to rise over the period as semiconductor chip shortages ease and on the gradually rising sales of hybrid vehicles, despite internal combustion engine sales remaining weak for the period. Palladium and rhodium demand should see some downward pressure from the gradual growth in battery electric vehicle sales, which does not require PGM-based autocatalysts. Despite the expected growth in EV adoption, there should be some sustained demand for PGMs. An example of this is the EU, which aims to ban the sale of non-carbon neutral internal combustion engine vehicles from 2035. However, internal combustion engine vehicle sales will be allowed if the vehicle can operate on carbon neutral fuels. So some of these vehicles actually do not require any modifications, which means that they will still need PGM-based autocatalysts. Platinum demand should rise as it has some more diversified applications. Industrial demand is expected to rise later on, boosted by glass making capacity additions, which is driven by the automotive and renewable energy sectors, where PGM catalysts are used to make the glass for vehicles and also for solar panels. But this industrial demand should face some downward pressure in the near term due to the weaker consumer demand. But we also see a rising demand for platinum from the development of the hydrogen economy, because it is used as a catalyst in proton exchange membrane electrolyzers. So PEM applications in electrolyzers are used to produce hydrogen, and it is also used in fuel cells, which use the hydrogen to give an electrical power output. So hydrogen-related PGM demand is a small part of total demand currently. We see here that it's only about 1% currently, and we're expecting it to increase to about 35% of platinum use by 2040. The expectation of strong future growth in the hydrogen economy should boost platinum investment demand, and the strong demand for hydrogen is due to governments and companies aiming to use more clean energy instead of fossil fuels. So on the supply side, we see that South Africa is a major producer of all three PGMs, producing about 70 to 75% of platinum, about 80% of rhodium, and we're only second to Russia with 38% of palladium production. Therefore, South Africa's supply problems affect the overall PGM market, with platinum and rhodium being affected the most. So supply declined in 2023 due to the high inflation and increased severity and frequency of load shedding. We expect some slow supply recovery from 2024, with some mine startups and expansions planned over the period. However, supply growth should be constrained due to the low PGM prices, coupled with a high cost environment, which should put pressure on profitability margins and may discourage further investments. Some of the supply constraints in South Africa include high operating costs, as 80% of mines are underground operations. The rising price of electricity and labor also adds to these costs. We see electricity cable theft that has impacted some operations. This seems to be a problem that persists despite the government's efforts to deter vandalism and theft. Some miners also face lower ore grades, infrastructural closures, and geotechnical challenges. Amplats cut their production guidance for 2024 due to these factors. The potential for increased frequency and severity of load shedding could also reduce PGM production. There isn't an immediate solution to these power supply risks, but we are seeing an increasing trend for miners looking at alternative power supply solutions, such as wind and solar plants, with most of these coming online in about 2 years. Despite these challenges, we expect some supply recovery in South Africa in 2024, but some project delays can also be expected to cap the supply growth, as some producers may postpone investments in response to the low PGM price. We also expect some project startups and ramp-ups in Zimbabwe, the second largest producer in Africa. An example of this is Zimplats, who has smelters under construction and is currently refurbishing a refinery. However, the supply growth in Zimbabwe may also be held back due to these low PGM prices, and as Zimbabwe implemented a PGM royalty tax, which increases their production costs. So focusing a bit on palladium, Russia is the largest palladium producer with about 40% of global supply. We expect palladium production to remain constrained as Nornickel conducts smelter maintenance, which has been experiencing some difficulties in securing imported equipment due to self-sanctioning actions by some equipment suppliers and the geopolitical constraints in that region. So moving on to the price forecast, we see that prices have generally declined over the second half of 2023 due to the weak automotive and industrial demand and the slower than expected economic recovery in China. The rhodium prices also declined due to a high supply after glass makers in Asia liquidated their inventories amid a move to cheaper glass-making catalysts such as platinum. So focusing on the price forecast for platinum, prices should generally rise as hybrid vehicles and industrial demand gradually recovers, outpacing rising supply. Near-term prices should be held back on global growth concerns and high interest rates in some regions. We also expect weaker industrial demand in the near term as China slows down ahead of the Lunar New Year holiday in February. However, investment demand should pick up amid some gradual substitution in auto catalysts, where platinum could replace palladium use as platinum is cheaper. Demand should also rise on hydrogen economy growth and safe haven demand, which should put upwards pressure on prices due to the geopolitical tensions in the Middle East. Palladium prices should trend downwards on slowing internal combustion engine sales demand amid the gradual adoption of EVs and some substitution by platinum. Prices should be further weighed down on the slow supply growth from South Africa, but these price declines should be held back by the Russian supply constraints and the tightening emission standards alongside the growing demand for hybrid vehicles. So lastly, rhodium prices should generally rise on the preference of rhodium being used in auto catalysts because it's a more effective catalyst than platinum or palladium. We see these prices rising on the demand for hybrid vehicles and the tightening emissions regulations alongside the slow supply growth. However, these near-term prices should remain volatile amid a weaker than expected automotive demand and a slower than expected industrial recovery in China. So Chinese industrial demand should also be weak in the near term as some glass makers reduce production and slow down their production ahead of the Lunar New Year holiday in February. However, after and later on in the period, we do see this demand rising once again. So that concludes the PGM section. We're now going to go into the Q&A portion of the webinar.
Okay, so thanks a lot. I do see we have some questions already. And if anyone else has a question, please use the Q&A button. It is, if you're on a computer, it should be near the top of your screen between the chat and the people button. So please, if you'd also like to ask a question, click on the button, type it, and we'll get to it. So if we start with the questions we have so far, first one I'm going to ask Devon to answer. So the question is, with India ramping up their steel making, do you see potential for demand growth for South African iron ore and manganese ore?
Interesting. So just for context, India is planning to ramp up their steel production to around 300 million tons per annum. So this is a 120% increase from what they produced last year. So the demand growth is definitely there. Although India does, what we've seen since last year, they've been auctioning a lot of their own iron ore mines, and they are quite sufficient in terms of iron ore supply. Where they import less than 0.5% of South African iron ore. So not too much demand growth for South African iron ore, but more positive on the manganese side. They are the second largest importer of South African manganese behind China. And with this ramp up and with the vast resource that South Africa does have, and with that ramp, it should support some demand growth for South African manganese.
Okay. So yes, please, as I said, if you have a question, type it in the Q&A area. Also on screen right now, I've got Sebastian, who's our Business Development Officer, and Marilee, who's our Client Servicing Officer, their email addresses. If you're interested in something you've seen today, if you're interested in Afriforesight, please send an email and they'll get back to you. But as we shift back to the questions, Kirti, one over on electric vehicles, question around the slowdown in EV sales. Do we know what caused the slowdown?
Yeah, so the slowdown was caused due to the high interest rate environment, which discouraged consumers from buying new vehicles. EVs are also generally more expensive than a combustion engine vehicle. So we saw that slowdown in sales as some governments also ended the EV subsidies, which made EVs more expensive to buy without the help from the subsidies. And some governments are also making subsidies more difficult to acquire as they're increasing the requirements that a vehicle needs to meet to be eligible for a subsidy. So that contributes to the slowdown in vehicle sales.
And I think we've seen quite a lot of that just now in January. There was quite a lot coming out of the US around subsidies.
Yes. So yes, so the US increased their requirements for critical mineral supply and for battery assembly and vehicle assembly. They're pushing for more of their battery materials and more of their vehicle assembly to be done in North America.
Very interesting. So Kirti, another question for you on the platinum side of things this time, though. There's a question around platinum supply and demand. And do we know if there's going to be a shortfall in the near term or an oversupply of platinum?
Okay, so platinum is expected to be in a deficit in 2024. So we are seeing this, even though there's slow demand, we are seeing the demand outpace the supply. So that's a factor that's contributing to pushing up the platinum prices as well.
Okay, so that's quite interesting. Where are we seeing most of that demand growth coming from?
Yeah, so the demand growth is coming from the vehicle space. So that gradual growth in vehicle sales, we're seeing that vehicle auto catalysts are the main driver for platinum demand. And especially since a lot of governments are now increasing their emission standards, they want vehicles to emit less harmful gases. So these auto catalysts now require more platinum and palladium and rhodium use just to push down those emissions from the vehicle. So that's contributing to platinum demand. Platinum's also seeing growing demand from the hydrogen economy, which is very small at the moment, but is growing at a rapid pace.
Okay, and these things all bode well for the South African space because we are still the largest platinum producer.
Yeah, we are still the largest platinum producer, and we should remain the largest platinum producer for this year.
Okay, then one around the coal side of things. There's a question about who is South Africa's main competitor in the Asian space. So I can answer this. So yes, South Africa mainly sells to Asia, but our big competitors over there are Australia and Indonesia. Indonesia exports more coal. They're the largest seaborne exporter of thermal coal, but they tend to export low-grade coal, whereas Australia tends to export high-grade coal. So those are our two big competitors, and they both do supply to India, which is our big market. So if South Africa has coal export problems, India usually looks to Indonesia, which is a little bit cheaper, but poorer quality, or Australia, which is generally a bit more expensive, but higher quality coal. So those are the countries to watch if South Africa is not supplying coal into the Asian market. Okay, then also on seaborne supply, Devon, there's a question here on iron ore supply growth. So there's iron ore supply growth coming out of the two big players, Australia and Brazil, and we are still seeing iron ore mining being profitable. What's the outlook, though, for South African supply growth? Are South African miners also ramping up to take advantage of that high profitability?
So yeah, there are definitely plans in the pipeline. We have seen Kumba's, Anglo America's Kumba working on their ultra high density media separation plant, and both at the Sishen and Kuala Mill operations ramp ups there. Although initially, or in the beginning of last year, they were expecting to get their production to about 40 million tons by 2025, but have in the latest report indicated that they're actually going to maintain their production at around a 36 million ton mark until the end of 2026. In the beginning of last year, they already suffered some build up of inventories on site, which forced them to slow down production. Where currently they this is sorry, given South Africa's logistics constraints that have built up those inventories. They they have now delayed some of those ramp ups and developments and have maintained their production outlook, at least until some of those developments can come, or sorry, the infrastructure improvements can happen later. But also a lot of the maintaining production is also for cost saving. Operating costs in South Africa tend to be higher than those in Australia and Brazil, where they have the most efficient logistics infrastructure and automation, which helps their cost modeling.
Okay. Then I see a few questions on gold. I'm going to try to group these up. So broadly, questions on the gold price and safe haven demand. So let me try and speak to this. So Afriforesight's view on gold prices is we generally see gold prices rising. So the question around safe haven, that's the big driver. Humans tend to buy gold as a safe haven asset. Gold doesn't pay a premium. It doesn't give you interest. It doesn't give you dividends. But if you're worried about the world economy, if you're worried about wars breaking out, if you're worried about inflation, people tend to buy gold and store it. And that's what's pushing up on gold prices. Also, probably going to push up on gold prices in the second half of the year is we expect interest rates to start to decline in the second half of the year. And when interest rates are declining, then there's more incentive to hold gold. So gold prices generally rising. Safe haven, absolutely. As I said, there's a war happening in Ukraine. There's a war in the Gaza Strip. There are concerns around China and Taiwan that drive safe haven demand. And then also declining interest rates later in the year should push up on gold prices. Then some interesting ones coming out about EVs, Kirti. So a question around EV infrastructure. Perhaps not growing as quickly as people had hoped, and perhaps that's putting some downward pressure on EV sales?
Yes, so it has in some regions. We see places like the US and Europe, which are strongly pushing EV infrastructure growth, and they do have a good supply of EV chargers. It's just certain countries, like smaller countries, like especially in Asia, where they're seeing a shortage of EV charging infrastructure because EV adoption has been much faster in those regions. But yes, the sales of EVs may have declined due to the anxiety over charging stations and the time it would take to charge your car. So that has contributed to the lack of sales, especially since we've seen in January this year, the US has reported charging problems where cars don't charge in colder weather. They also struggle in warmer weather. So this is a developing technology as well. So hopefully in the next few years, we should see EVs develop some easier charging systems, and hopefully that the infrastructure for chargers will grow as well in more regions.
Okay, then also on EVs, a question around repairs and insurance. Now, this obviously isn't our main part of our forecasting, but we have seen some issues around EV repairs and high insurance costs. If you could speak to that for a bit.
Yes, so an EV, unlike a normal car, is going to be a lot harder to repair. We're not going to find service stations and mechanics that can fix EVs as easily as they would a car with engine. So what's been happening in the insurance space is that if an EV car meets in any kind of accident, the car would have to be written off purely because if the battery pack is compromised, it's unsafe to drive this vehicle or even store this vehicle near your home or near other cars in the event of a fire. And EV fires are much harder to put out and cannot be put out with just plain water. It is usually left to burn until it runs itself out of fuel. So yeah, so that's the problem with EVs. And due to all of these issues, insurance prices for EVs have gone up purely because a lot of people have to write off their car after even a minor accident.
Okay. Then on the jewelry side, Kirti, so question around gold and platinum. Are we perhaps seeing an increase in platinum jewelry demand? Because today platinum is basically half the price of gold. Are we maybe seeing a ramp up in platinum use for jewelry?
So jewelry demand in the near term has been weak, and that's because of the global growth concerns. Like Vinesh had mentioned earlier, people are spending more on their cars, their bonds. People have not been buying jewelry as much as they used to. But later on in the period, we should expect jewelry sales to pick up, especially towards the end of the period, like around December, when people have their seasonal, the festive period sales. So jewelry demand should rise.
Okay. Then a very interesting one coming out here around the problems at Durban Port, rail and port question. This could probably be a webinar in itself. Let me start with if you are a Afriforesight client, we have in the last 2 months or so started a ship tracker. Every Monday we show our clients the port backlogs at ports in South Africa, Namibia, and Mozambique. Do we see this getting resolved? So there's a question of what is resolved. So things generally got better from the middle of December into early January. We saw the port queues at Durban and Richards Bay and Cape Town getting a little bit better. But now with ships trying to avoid the Red Sea, we are seeing more ships heading towards South Africa and around South Africa, more ships trying to refuel. And again, South Africa's ship refueling or bunkering infrastructure isn't the best. So we are seeing a pickup in the backlog. So do we see it eventually getting resolved? Yes, Transnet is on it. Government does see this as a priority, but it takes time. It is not an easy thing to clear a backlog of 60 plus ships. So things have generally been improving, but now we see more ships heading South Africa's way. Does make for things being quite difficult, but certainly it is something that Transnet is trying to resolve. Then also a question, Kirti, around copper and aluminium substitution. What's the situation there, and do we see potential increased use of aluminium adding upward price pressure for aluminium as well as bauxite?
Yeah, so we're seeing a slow increase in substitution with aluminium. The thing is, copper has the best conductive abilities, and everyone prefers copper in their electrical equipment or for wiring. But due to these theft reasons, they're using aluminium in public spaces. So we are seeing an upwards trend in aluminium prices. And this is a very small portion of why aluminium prices are going up.
Okay, and while copper is the better conductor, there is a cost advantage, correct? Aluminium is quite a bit cheaper than copper.
Yes, aluminium is at a lower price than copper at the moment.
Okay, then also while we're on prices, Kirti, there's a question around platinum prices. So we see prices rising, but how low can prices get? I think there might already be an argument that PGM prices are at the point where miners are reducing production to a certain extent. We've seen quite a lot of layoffs announced. Go ahead.
Yes, so platinum prices are expected to increase over this period, and we're even seeing increases further into the future. And we're hoping that platinum prices don't decrease any further because we're already seeing some production cuts. We're seeing further mine expansions being postponed to a later date in hopes that they will restart these production and they'll restart these supply expansions once the prices increased a bit. We're also seeing some miners cut their costs. We're seeing this cost cutting in the closure of certain shafts. We're seeing it as job cuts. We're also seeing it as the use of like investing in solar panels instead of using generators when there's load shedding.
Okay, so
yeah, so that's also a factor. Like if load shedding does get worse, it should actually push the platinum price up because that constrains production a lot.
So we're probably very near, if not at the sort of the bottom price that miners can accept. Yes. Okay. Then quite a broad question here on mining capex in investment in mining. What are we seeing? So, I mean, certainly we've seen prices come down recently. I know there was this question in 2022 around commodity super cycles. And as Afriforesight, we tried to temper expectations. We said, you know, prices are going up, but China is different compared to the early to mid 2000s. So we've seen prices generally come down over 2003. Some industries got hit harder than others. I think of platinum got hit particularly hard, whereas as others like chrome ore held up quite well. But generally, commodity prices have been coming down, and we are seeing profitability issues. Quite a lot of mining companies making less money in 23 than they did in 22, and announcing scaling back in investment is a lot of what we're seeing. Kirti, I know lithium in particular, we've seen people cutting back, but also in things like nickel, we've started to see issues with investment over there. And certainly in thermal coal, we've seen miners saying, you know, maybe this isn't the time to be expanding things. So I think in general, we have seen mining profitability come down, and companies, if they haven't already, are probably looking to scale back their investment on these generally lower prices. So there certainly still is money to be made in mining, but it's not as good as it was back in 2022. Okay. So if anyone else does still have a last minute question or two, please, again, use the Q&A button. But overall, I think the big thing to take away is mining is still profitable. Yes, we do see some issues, particularly PGM miners in South Africa and Southern Africa are struggling, but there is still money to be made in the mining space. Also, as I said, if you are new to Afriforesight or new to our webinars and you'd like to find out more, please feel free to contact Sebastian or Murali via email, and they'll be able to help you out with questions you have about what we have to offer, subscriptions and the like. Similarly, if you are already a subscriber of ours, but you're interested in something extra that maybe you don't normally get, please reach out to them and they'd be happy to help you out. Right, I am not seeing any other questions at this point, so I would just remind everyone that the recording will be available a little bit later. It should be in your feed that you used for Teams. If you open the same link that you used to join the meeting, you should be able to get the recording over there. I'd like to thank everyone for coming out today. Thank you so much for your time. It was great being able to present to you. We look forward to talking to you again soon. From everyone at the Afriforesight team, thank you so much and have a great day going forward.